Want a sneak peek into the backtesting bootcamp? Well, today's video is going to be that. I'm going to be releasing the video I gave to everyone that signed up for the email on how to backtest bootcamp. Currently, the backtesting bootcamp is in motion, and we are kind of just working with everyone, kind of getting them to grips with pulling data, analyzing data, applying data, and doing some more complex stuff like Monte Carlo Python simulations. However, I wanted to release this video so everyone can experience at least a part of it. And I think this video is really important. It's basically the top 5 biases when backtesting and how we can do a couple things to try and avoid them and basically just bring awareness to them so that when you're backtesting, you can understand them. And that's enough from me, so I'm going to get straight into the video and I hope you enjoy. Backtesting Bootcamp, Topic 5, Biases. What is a bias? Backtesting biases refer to the potential for the results of a trading strategy backtest to be misleading. While backtesting is a great tool for you to evaluate the performance of a strategy, there are several biases that can affect the results. These biases can cause the backtested results to be different from what would have actually happened if the strategy had been used in real-time trading during that period. Let's look at a number of frequent biases to be aware of when backtesting. Now we're going to go over survivorship bias, look-ahead bias, overfitting bias, and lastly, inaccurate data bias. For survivorship bias, it is a very common bias that can occur when backtesting a trading strategy. It refers to the tendency to include only the investments or stocks that are still in business today in your analysis, while ignoring the ones that have gone bankrupt or delisted from the stock exchange. This can lead to an overestimating the performance of a trading strategy as it does not take into account the investments that have failed. In trading, survivorship bias can have a significant impact on the accuracy of backtesting results, particularly in small caps and large caps. Small cap companies are more likely to fail than large cap companies, so excluding the failed small cap companies from your analysis can lead to an overestimation of the trading strategy's performance. On the other hand, large cap companies are more likely to survive. However, only including successful large cap companies can also be troublesome, causing a similar issue of an overestimation of the trading strategy's performance. In futures trading, survivorship bias can also occur if the backtesting data only includes the futures contracts that are still actively traded today. This can lead to an overestimation of the trade strategy's performance as it does not take into account the futures contracts that have expired. This, however, can easily be solved using a continuous contract to backtest on or downloading data from all previous contracts, and this is automatically done for you on some platforms such as NinjaTrader. An example of a survivorship bias: imagine you are backtesting a trading strategy on a set of stocks from the past. You only include the stocks that are still in business today and ignore the ones that went bankrupt or were delisted. The backtested results show that the trading strategy had a high rate of return. However, if you had included the failed stocks in your analysis, the results would have shown a much lower rate of return. This is an example of survivorship bias and how it can affect the accuracy of the backtesting results. To avoid survivorship bias in backtesting, you'll need to include failed stocks or previous contracts in your dataset to either simulate your strategy over or to do your analysis on. Fortunately, this is now relatively simple. The data supply we endorse and urge other users to use is Polygon.io. They provide all delisted stocks in their API, allowing you to use the templates and obtain data using their API to ensure that your analysis is free of this bias. You can see below an image that just confirms that they are keeping delisted tickers in their dataset that you can pull from using the API. Look-ahead bias is another common bias that can occur when backtesting a trading strategy. It refers to the use of information that was not available at the time of the trade in the backtest. This can lead to an overestimating of the performance of a trading strategy as it does not accurately represent what would have happened in real-time trading. In trading, look-ahead bias can have a significant impact on the accuracy of the backtesting results. For example, imagine you are backtesting a trading strategy using today's closing price. This is an example of a look-ahead bias as the closing prices were not available at the time the trades were made, allowing the backtest to provide spectacular results that are not representative of the strategy's live performance during that time period. To avoid look-ahead bias in backtesting, you can use historical data that was available at the time of the trades that were made. Furthermore, you'll need to assess what information you are using for your strategy requirements and ensure that it is present prior to or at the time of the trade. A common mistake I see is people testing strategies on gappers that close red, which is a huge look-ahead bias. Let's say you're a trader who wants to run a strategy that takes advantages of trends. You decide to look at assets that trend and discard the ones that don't. You then run a strategy on those assets using a trendline strategy, and unsurprisingly, your strategy does well. However, this backtest is a bit biased due to the look-ahead bias. By choosing only assets that have already trended in the past, you're essentially using information that was not available at the time of that trade. This can lead to the overestimation of the performance of that strategy, as it does not accurately represent what would have happened in real-time trading. In summary, look-ahead bias is a common bias that can occur when backtesting a trading strategy. It can lead to inaccurate backtesting results and can negatively impact the performance of a trading strategy in real-time trading. You can avoid this bias by using historical data that was available at the time of the trade. Overfitting bias is another common bias that can occur when backtesting a trading strategy. It refers to the tendency to create a trading strategy that fits the historical data too closely. This leads to an overestimation of the performance of the strategy, as the strategy will not be effective to the changes in market conditions and will not work well in real-time trading or unseen data. In trading, overfitting bias is a common and significant bias that impacts the accuracy of backtesting results. For example, imagine you are developing a trading strategy based on historical data. You create a strategy that fits the data closely and yields the highest returns in the whole backtest. However, if the strategy is too closely fitted to the historical data, it will not be robust enough to perform well in real-time trading. To avoid overfitting bias in backtesting, there is no universal method. There is a critical step that we call robustness testing. This is a whole section on how to avoid overfitting and apply it to different markets. However, in general, you should not choose the best results if it sacrifices sample size or trade amounts. Lower the number of degrees of freedom in your strategy. This is the number of variables that can be changed. You want to make sure to walk forward or out of sample testing your strategy. And finally, you can use a Monte Carlo simulation to help this as well. All these topics will be covered in a subsequent topic that you can look forward to. Inaccurate data bias is another bias that can occur when backtesting a trading strategy. It refers to the use of inaccurate or unrealistic price simulations in the backtest, which can lead to overestimating the performance of a trading strategy. In trading, inaccurate data bias can have a significant impact on backtesting accuracy. Consider backtesting a trading strategy that relies on accurate price data. However, not all platforms use the exact historical price movements. Instead, some use simulated fake price movements. This may be insignificant if you only trade on a higher time frame, such as maybe daily bars, and analyze the market using end-of-day data. However, if you're trading a strategy that is based on intraday timeframes and involves a high volume of trades per day, inaccurate price data can have a significant impact on the accuracy of your backtesting results. For example, if you're developing a scalping strategy for a specific ticker, you develop a strategy and then backtest it using simulated fake price movements due to the lack of tick historical data or lower timeframe data on the platform you're using. If the simulated fake price movements do not accurately reflect the real market conditions, the backtest's results will not accurately represent what would have happened in real-time trading. This can lead to the overestimation of the performance of the trading strategy and negatively impact the performance of the strategy in real-time trading. This is very common in TradingView backtests because they use assumptions to create fake data inside a candlestick bar, causing the backtest to say your profit target was hit before your stop was hit in the same candle, where in fact maybe your stop was actually hit first and then it would have been your profit target. This is just a screenshot showing you from their FAQ page where they kind of state that they're using assumptions and they don't actually know the actual data in between those bars of what was hit first. So they'll be making assumptions and just calculating it basically at random, which isn't very useful for your actual backtests. This is a very dangerous bias because it can destroy the foundation of your strategy. However, it is only really applicable in certain circumstances, primarily when doing very low timeframe strategies. The best way really to avoid this is just to use tick data or reliable data sources such as Polygon, where we can use lower timeframes as well and get very accurate data. Overall, being aware of these biases when backtesting a trading strategy is important for accuracy of results and strategy development. If you take the time to understand these biases and take the steps to avoid them, you are likely to be very successful in the long run when backtesting. This was topic 5. I hope you kind of learned how those biases may affect your backtesting, which hopefully should have paid off your ignorance there regarding the potential biases that you may be unaware of, which will no longer bother you in your backtests.